the week past. What a week it was, one has to say. Prices more or less, ended up where they started, well above 70 on Brent. Even WTI popped above 70. But we all had the Ida storm, we had the OPEC meeting, and at the end of the week, we had the US jobs numbers, which at 250,000 were 1/3 of the expectation, which in itself was quite a shock. Let's kick off this morning with Christof Rühl. Christof, good morning and welcome your thoughts on the jobs report, maybe as a kickoff. A real surprise. I mean, it was building an expectation, but nonetheless, 1/3 of what the market expected.
Good morning. Yes, that was a surprise, but I'm not sure it is all that significant. People now immediately jump to the conclusion that tapering is on hold. I'd be careful with that. There's a few things around this. Number one, this is notoriously volatile data, as we have seen many times before, and as everybody knows, it jumps around an awful lot. But you're right, 1/3 of expectations is very, very low. The more important background stuff here, less talked about, is that this reflects already or still an improvement in the rate of unemployment. So even in the summer season, when people go on holidays and want to travel and do whatever, the economy continued to employ more people and the unemployment slightly edged down. And number two, there's something very strange about these numbers, which is that average earnings, hourly earnings, wages, in other words, which had been expected to fall a little bit despite the high expectations for additional employment, actually went up. And so it seems to be a labor market where labor still is in short supply, otherwise the payments wouldn't go up, and that new jobs have been disappointing. And now we have to step back a little bit and think about what this signifies. There is the new policy of the Fed, which states that they have to now not just a full employment target measured by unemployment, but they want to get everybody, red hot economy, labor market, as they always said, everybody should get off his couch and being employed. And it seems to be that there is just a fair number of people still sitting on their couch who prepared to do something else, which despite rising wages have not joined the labor force there. So it's not all a picture of people standing on the corners not finding jobs. It's also a picture of people for many reasons, children still not in school, benefit payments still being used up. People are not prepared to go hamburger flipping if they don't have to. So that is one thing. Then the other thing, there is of course now the conclusion that the Fed will stop tapering, and that matters for economy and oil demand and all that. Normally, I would say this 1 month's data is sort of a bit of a blip and wait and see. But there is also the history of the Fed over many, many years now, that every time a signal points at a very strong economy, they back off. Every time the signal points at a very weak economy, they're happy to buy more bonds, keep interest rates on hold and loosen up some more. Given this asymmetric response, which has been pointed out more and more often now, if that remains in place, and I think it will, then indeed this may have put a question mark now on the willingness to taper before the year.
Well, let's welcome back to our table of Jorge Montepeque. Welcome, Jorge. Nice to see you back, president and founder of Global Markets. It's been a while since we've had you at the table, so perhaps there's a big window of time to reflect upon your views. The month of August, we saw the oil price drop heavily and then recover quite strongly. OPEC came through with their rollover decision last week. Where do you see that in terms of basic supply and demand fundamentals at the moment?
Well, number one, demand keeps on growing up despite COVID. So demand is still expected to be, of course, below the pandemic level, but if anything, will be under by only about 5 million barrels per day. At the same time, the OPEC members and overall global supply has not been keeping up pace with the demand. It's still restrained. So the inventory destruction continues globally very strongly. And in this past week, then we have things like hurricanes, and then the inventory destruction accelerates. So we are in a situation where I think we need to be ready for some price surprises. And the surprises will be blips, strong blips to the upside. I think the first strong surprise we have seen this past couple of weeks is in natural gas. Natural gas is soaring. The price of LNG traded globally is soaring as well. I think it has jumped over $20 per million BTUs. And that means on an equivalent of over $120 oil equivalent per barrel. And that means that the supply chains globally, and this is not just for oil, it's for everything, are really messed up still because of COVID. And with the inflow of cash the economists have seen globally, people still want to spend and have the ability to spend. So I would also like to hear Christof's views on this. But to me, I am very ready to see those upward, very surprising blips in prices.
I mean, well, Christof, on that point, I mean, just take it away. And also, I wanted to add, obviously, the continuation of the sort of bearish outlook from the Fed in terms of being ultra accommodating. It sort of contributes to that upward posture that Jorge points to.
I mean, come on, let's face it. Jorge, you said was gone for a while, but according to the statements you made the last couple of sessions, prices should now be in their 80s. And here we are, a huge hurricane later, and Fed, being very reluctant to do anything later. People traveling over the thing, and it hasn't barely moved and barely blipped upwards. 90-odd%, 1.7 million barrels per day is still out on the Gulf Coast, and prices have not jumped up, and that indicates to me a very well supplied market. In addition, and independent from the fact that OPEC still has plenty spare capacity to go. Let's face it, third quarter 2021, the global economy is back exactly at the levels which it had reached at the end of 2019. Oil demand, as you say, 5 million barrels per day lower. Historical sort of productivity improvements in the way we consume oil would indicate that 2 years later, to reach the same output employment which we had before, you would need about 4.3% less, not 5. So there is slow growth in that system. All the stellar numbers you quoted last time about air travel back to 100%, now they say it's 30% below what it was in 2019. And so it's just moving much slower. And the reason it's moving much slower is the economy. And the surprise it's moving much slower is the economy, despite all these huge transfer payments and all this money being injected and so on. So we are steering still, through this narrow gap between another mutant virus and between sliding into hyperinflation. And it's a difficult journey. And I think that's the reason why OPEC sort of remained cautious in its output adjustments. And that's the reason why we're seeing things like hurricanes knocking out production in the Gulf and barely a blip in prices. And in the future, don't forget, where we have the major damage now to talk about the US and take up that ball, is the refining capacity. And refineries being destroyed means that there's less demand for crude, but more.
Jorge,
and prices gone.
Give Jorge a chance to comment on that, but also on the question, is the rebound over? You mentioned the idea of growth, global growth. We're seeing in China the sort of correction down from the point of view of growth expectation for 21. We're seeing in the US now some element that, I don't know if this number on Friday is indicative of the rebound, if you like. The rubber band has been pulled, it's come back, and we're kind of, growth, organic growth just isn't picking up the slack. Your thoughts?
Okay. From my point of view, a few issues that, of course, no one can forecast, but one should be ready to accept. Number one, China intervened in the refinery sector by stepping on the teapots. And that led to a decrease in demand. And China has been one of the main drivers in energy demand, not just oil, but gas. That incident on the teapots is already behind us. And now Chinese demand is back. They keep on sucking in more oil at the pace as before. The other one is the disappointing performance of the COVID vaccines. I am a person, and I have to be very fair with this, that has had a great reliance and hope on science. But the fact is that the infection levels after being vaccinated are not very good. We still can cross-contaminate each other. I am fully vaccinated. I want to be vaccinated again. But the fact is, I am naturally cautious of being too close to people because people can get infected. So the economy is still struggling more than
We're
I
seeing
thought.
in the US, Jorge, on the forecast for this Labor Day weekend that the expectations of fuel consumption are below what they were originally thought to be because people are cautious with the Delta variant. And of
Yes.
course, there's still a very large percentage of the American population that are not vaccinated, with over 100,000 infections every day.
Yes. So you have people like myself that are cautious, are fully vaccinated, but are cautious. And then you have what I can see, at least from a London point of view, a growing sector of people that actually don't care. And I have seen in the trains and underground transportation system, less of a tendency to use masks. So every week, the usage of masks keeps on dropping. About a month ago, it was probably 70% of the people were willingly wearing masks. Now it's 20 or 30% and dropping. Every week I see it dropping. So in a way, we are learning to live with COVID. But this will lead to surges and these disturbances in demand. But if we take the whole picture, demand for energy in the US, and they are the world leader that we all look at in this sector, is now about the highest it has ever been. And a hurricane, as we have seen, destroys both supply and demand equally. But demand will need to come back as people start rebuilding their homes and getting back into their normal routines. Let's not forget that the market demand drops a little bit in the fall. But as we head into the winter, we are coming ever closer to normal consumption levels. And as I said, we had a big wake-up call with gas. Gas demand is very high and prices are extremely high, right?
And there's been very big warnings about that, particularly in Europe coming into the winter. Christof, on the point essentially that demand continues to outpace supply as we're seeing global inventories contract every week, and we're dropping well below the 5-year average now. Your thoughts on that trend line, regardless of all the other noise, but ultimately on the markets are tight and falling. Should OPEC Plus and others allow the inventories to continue to fall? Is there any risk in that move, do you think?
I mean, there's so many disjointed bits and pieces on the floor now. But
yes.
Yeah, I don't agree with this analysis of the vaccination at all. But let's stick to your demand question for now. Demand, first of all, the oil market, for all intents and purposes for the last 100 years has been a global market, and that's where prices are determined. Global demand every year is the highest it's ever been, so that's not exactly news, and it's not, as I said, it's 5 million below where it was in 2019. Inventories still drop, and I don't know to what an extent this is now also the preparation of run up to Labor Day, and to what an extent it is refineries not being exactly to follow. But I do think that OPEC sees that gleefully, because if inventories were to accumulate, prices would be faster to come down than they are to come up now or to stabilize, precisely because that is a market, as everybody knows, which is not exactly short of crude oil supplies. So I would think that what we are seeing is, of course, there's always the risk of price spikes, is a world where for now, with this large uncertainty also of the virus and so, it's pretty safe to say 70 plus minus 5 is sort of a range with which OPEC can live. And they will cautiously guard that by being cautious on the supply extension. And to answer your question directly, yes, I think that will remain the case until the end of the year. And in particularly might be even get a bit tighter when if the Fed indeed starts tapering, which we don't know at this point. But I think for now they're sitting quite comfortable. They've done a good job and they've projected roughly right, and that's the most one can expect here.
Jorge,
there is two other
sorry,
aspects we should discuss. I will not talk forever now.
No, please.
One is the COVID picture, and the other one is natural gas, which is indeed an important development. So.
Yeah, Jorge, I wanted just to pick up on your comments regarding China, whether you see any, I mean, you point towards we need to prepare for $100 or some sort of, surprise on the oil price. But I'm wondering, your thoughts are, does China's current behavior concern you in any way? The latest headline in the digest today, just the latest of a number of sort of a very government intervention now going after movie actors who aren't politically aligned with the system. We've had a series of these sorts of Big Brother, last week it was kids could only play on games 1 hour a week. All of these pieces over the recent months, what do they add up to you? Do they mean anything? Should it be something to be concerned about? What's your thoughts?
Yeah, a friend, I'll share something with you and the viewers. A friend of mine alerted me of the latest moves to restrain actors and TV personalities. And my reply was very simple, was sell China. All this means is that the growth in China will be lower than before because the government is intervening and preventing market forces to prevail. When you intervene with too much taxation, too much regulation, too much Big Brother, your growth incline decreases. We have seen that in Europe in years past. We have seen that in the US when the government grows too much. And now we are seeing that in China. So I think I still expect China to grow, but all these measures are going to take away confidence, are taking away confidence already, are affecting their stock markets. And therefore, we need to be ready for a lower incline. How much that is, we don't know, but any economist would tell you that it's going to be less than it would have been otherwise.
Christof,
and that's part of the overall world reset, I think.
For once, Jose, I agree, China, that this will affect. I mean, what we see is we have puzzled around for months now what is going on in China. Now the picture becomes increasingly clearer, and it is one of these occasional purges. Good old Stalin said, you need to have the occasional purge, otherwise discipline breaks down. And Mr. Xi wants to be seen as the biggest Chinese leader since Deng Xiaoping, at least. And so that's what we are seeing. A reassessment of control and the impact on economic growth, of course, will be necessary. Will be negative, and we have seen this time again: 3 steps forwards, 2 steps back. Now we're in the 2 steps back mode. In a situation where it has increasingly alarmed the Chinese leadership that the US is turning openly, I won't say hostile, but calling itself as a strategic competitor. And so they reassert control. And yes, Jose is right, that will impact economic growth. And guess what? It's still the biggest oil importer of the world. That will impact oil demand. And what we also have seen is how China sort of bought cheap when oil prices were very low, then spent more than they imported for a while. When the going was good and the growth rates were blipping up after COVID. And I think what is really relevant in both China and the US is the question you, Jean, asked earlier. Is this part of the rebound? And when is the rebound over? How does the reality in growth look like, which will settle in? And to me, unfortunately, the indicators in China are very clear at this point. The rebound is over, and the reality which settles in is growth somewhere in the region of 6%, not in the region of 8.5%. In the US, the jury is out. It might be a little bit better, but the rebound is also almost over. And then finally, one word on COVID. I think I agree also that we have learned now, we are going through the phase where we learn how to live with it. But it's not all doom and gloom, because it's just a bifurcation into vaccinated and non-vaccinated people. I've tried to get information on that, but it seems to me that the rate of infections among vaccinated people is well within the announced risk of having the vaccination when they were tested. And they said 97% safe and 3% get, unfortunately, the disease. But what is for sure, is that the transmission from infection into hospital stays and then from hospital stays into fatalities is much slower and lower for vaccinated people than for non-vaccinated people. You look at the US of these 100,000 people, apparently what's in the newspapers, 97% are non-vaccinated. And that will lead to some segmentation in the population later on in the US, which will be a problem. In Europe, it leads to a big problem because you can't refuse people treatment in hospitals, even if they refuse to vaccinate. So you're stuck with this 30-40% of ignorance who make it very expensive for everybody else. But it's by and large the end of lockdowns, which we are seeing, which raises one last point. One other thing which we'll discuss. It is the rest of the world is not yet vaccinated. And so this is where the mutations are going to come from. And now we are sitting here in Europe and in the US, and we are thinking, shall we have a booster shot in the fall? And the real question is, shall we have a booster shot in the fall, or shall we give the 2 shots to the people in Pakistan, Bangladesh, India, and elsewhere? That's much less discussed, but that's an unfortunate background.
We're certainly, we're seeing a lot of the new variants that have concern. Obviously, the Delta did come from India. The South African has also thrown up once or twice, where there's relatively low levels, although coming back. Jorge, I wanted to just touch on the gas and the LNG. This unprecedented levels of price going into ahead of the winter. Where does the implications of that for the oil markets? We're seeing as a result of high LNG costs, high sulfur oil is getting bought up, fuel oil for burning, for power supply. How do you see the ramifications of this elevated LNG gas price through the next winter?
Yeah, well, there is a short-term situation, and I think IDA, among other things, didn't help the gas prices if you're a consumer, because those markets don't have a lot of inventory, and therefore, if demand continues the same and supply is destroyed, prices just react. But globally, LNG demand has been growing up very strongly as people move away from sulfur emissions and carbon emissions. But I think all the policymakers have not been paying attention to the supply side. And oil companies and gas explorers, of course, react to the access and the cost of capital. And access to capital for oil exploration has become a little bit more difficult. So as an observer of markets, I think the general public and governments are in a way too bullish about green policies, which are reducing the supply of hydrocarbons over the long term, and at the same time hoping that prices remain low. And we already see the signs of a disjointed policy with, for instance, the Biden administration issuing a statement hoping for gasoline prices to be low and OPEC to behave and increase more supply. So they start to worry about these things. But to increase supply takes a long time. It's a 3 to 5 year journey at least. So when I'm talking about surprises in prices, I think we're going to have them. And it's not that we're just going to have them between now and the winter. We'll have them next year and the year after. There is too much demand for gas to produce electricity. The wind-driven electricity is not reliable. We still need to have surge capacity. And all these forces can only be resolved through price. All these imbalances can only be resolved through price. And price is already sending us signals. I will disagree with Christof.
Sorry.
I will disagree with Christof. If we are at 72 or 80, in a way, okay, it's a 10% difference in price. But no one 6 months ago was thinking we would be at 72 now. No one. And the possibility that we're going to be at 75 or higher remains there.
When did prices break through 70, Jorge? No one a few months would have thought about this. Of course, people talked about it at length. Look, it's always a safe bet to say there will be price surprises. The art is to figure out what's systematically going to happen, not the random. Sorry.
I just wanted to get the room in on the sort of bigger sort of narrative of the direction of travel in terms of the macroeconomic outlook. U.S. stock markets recorded a string of 53 closing highs in 2021, the fifth most in the past 100 years. The previous 4 episodes were followed by heavy market declines. Will this happen on this occasion? Yes in 2021, yes in 2022, yes in 23, or no? The Fed will keep feeding us and all will be well. So I welcome the view of the room. 53 closing highs in 2021, the fifth most in 100 years. The previous 4 resulted in heavy market declines. Will this happen on this occasion? Yes, 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 no. Boom, boom. Tough one. Looking to the week ahead, Christof, and sort of coming out of that point, I want to sort of get a sense of where do you think we're going, particularly in the context of the sort of Fed monetary policy piece. We're coming, yet to another Fed meeting in 2 weeks' time in the US. The question I have ultimately is, it seems the Fed's saying we've arrived at the number for inflation that we need to start doing something, but we haven't arrived at the number for jobs. But yet there's more empty jobs than there is unemployed. And those who are left unemployed from the crisis, if they're still on their couch, I'm not sure, with the most respect, how employable they are. And should we be managing a global monetary policy on the last few remaining unemployable people and the consequence of that? So just wondering your thoughts on those few things going forward.
Is exactly, there's 2 fault lines here which are important and where people will have to position themselves. One is this question of, should one have a symmetric response, which would indicate as inflation ticks up, inflation, not employment, that you start tapering, or should one be, as they call it now, be data driven and basically follow this asymmetric route further down to low rates, bigger monetary purchases, which we have seen over the last 10 odd years. And the second one is exactly leads us back to this. Remember that they have an employment target, but they redefined what can be done. So the new doctrine of the Fed after a big strategic review last year was to say, we can actually do much more for unemployment than we did previously. And we can do so without inflationary consequences. And this is where all this talk today now comes from. Normally, inflation, unemployment rate of 5%, a still growing employment rate and red hot sort of growth conditions with a huge stimulus, that would have been enough to step off the pedal. But now with, we can do more, we can do better. We explicit mentioning we need to employ more women, we need to employ more minorities, all these things. There's always someone in some corner of the room who says, oh, there's my Uncle Billy who didn't find a job and we need to do some more. Will this continue? And I think it probably will. I mean, they probably will do this. The natural counterpoint to evaluate the danger of doing too much should be the rate of inflation. Inflation rates and market expectations of it have ticked up. It has not led to a big reaction yet to the announcement of tapering. But this is sort of the very narrow course they have to scale between this fear of inflation and the new mandate of doing more on the employment front. I think they will come out on the side of erring in order to do too much for employment and creating more inflation than intended. So that in the end, those who have warned from the beginning that this policy might be inflationary, that there are huge inflationary risks, are more likely to be right than those who said this will lead us into this golden age where everybody and his grandfather is always employed and nobody has any problems. There's no money tree.
There's no money tree. Well, it seems to be one. I just don't know where it is, but it certainly seems to be in somewhere near Washington, D.C. Let's get the survey result and give Jorge the last word here. Just sort of work our way through here. So yes in 2022, yes in 2023. The yeses add up to being, certainly 75% or so, 70% that of this outcome. Jorge, your thoughts about what is coming in the immediate sense of the week ahead? The markets last week essentially did a bit up and down, but ended up more or less in the same place. We seem to be solidly in the low 70s now on Brent.
Yes, I think for next week, there will be a lot of focus on what the inventory figures show. And there is going to be more shocking numbers in the inventory destruction of crude oil and how far below the 5-year average will be. So I think next week we're all poised for a nice bump in prices. Christof will hold me accountable to that, as well as yourself and the viewers. But I think it's coming in. It's coming in.
Christof, before we wrap up, I just wanted to get a quick thought on you, and obviously it's not a quick subject, very big to close on, but stagflation, which is ultimately what we seem to be on the pathway to. What generally does that mean for the oil industry, for the major companies, for new capacity and investment?
It's generally speaking bad news because it denotes the situation of low economic growth. So those who are not dealing with economics every day, stagflation is a word creation, a mixture of stagnation and inflation. Very rare conditions where you have slow economic growth and high inflation rates. Usually possible only if you have a severe miscalculation on parts of central banks, creating more money, having too low interest rates at times when it's no longer justified, and then being slow to remove it, and inflationary expectations setting in so that people want higher wages, and then then other people put that into higher product prices, and you have these kind of cycles developing. That's what many people are afraid of. It leads investors to invest into value stocks and into inflation protection. So that would to some extent also be commodities, but the emphasis on value is, and the prices, the commodity prices and the oil price today would imply that this is already pretty maxed out. So you might expect them to see it go into precious metals, but not into oil and gas.
Let's just wrap up on that. I think it's a point and it's an area to keep a close eye on. We're starting to see the investment portfolios move towards a stagflation posture, which in of itself could sort of predetermine the direction of things. I also wanted to note there's a story on Bloomberg that sort of looks at China and says, could this crackdown be a second cultural revolution? It struck me that what happened in Texas last week, without getting too granular on the details of the new draconian law that was passed there regarding family planning, could that indeed be a cultural revolution in the US, where the Roe versus Wade infamous law case on family planning gets knocked down by the very, very conservative Supreme Court and sets the country up for a major collision, like we have a Trumpian collision that makes January 6th seems like a curtain raiser. Something to keep an eye on. It's not on the immediate, but it's certainly something that is, I think, going to heat up. Well, let's wrap it up there. Jorge, thank you so much for your thoughts and your contribution today from London. And Christof, as always, anchoring us on a Sunday morning. Really appreciate those insights. Have a great week, everybody. We'll catch you every morning at 10:30 UAE time. All the best.
All the best. Thank you.